The Reserve Bank of India's Monetary Policy Committee, RBI-MPC, voted to keep the repo rate unchanged at 4% in its last meeting. The repo rate is the interest rate at which the RBI lends money to commercial banks by buying their securities with an agreement to repurchase them later. The RBI uses the repo rate to control inflation and money supply in the economy. The RBI has increased the repo rate by 50 basis points to 5.4% in September 2022, the third consecutive hike since April 2022, when it was 4%. The RBI has also withdrawn the accommodative stance of monetary policy and lowered the GDP growth forecast for FY. The repo rate hike is aimed at containing the rising inflation, which has been above the RBI's target of 4% for several months. The repo rate hike also affects the borrowing costs of consumers and businesses, as well as the exchange rate of the rupee. The repo rate is a key instrument for the RBI to manage the monetary policy and balance the growth and inflation objectives. The RBI-MPC may not change interest rates in the upcoming meeting due to factors such as a sustained moderation of the headline retail inflation, a better-than-expected GDP growth print in Q4 FY23, and global uncertainties and risks. Let's look at each of these factors in detail. First, the headline retail inflation, which measures the change in the prices of goods and services consumed by households, has been easing for the past few months. In April 2023, it stood at 4.29%, well within the RBI's target range of 2 to 6%. This was mainly driven by a decline in food and fuel prices, as well as a favorable base effect. The RBI expects the inflation trajectory to remain benign in the near term, barring any supply shocks or demand pressures. Second, the GDP growth print for Q4 FY23 came in at 8.3%, beating market expectations and showing a strong recovery from the pandemic-induced contraction. This was supported by a robust performance of the manufacturing, construction, and services sectors, as well as a revival in consumer and investment demand. The RBI projects the GDP growth for FY24 to be around 9.5%, reflecting the positive momentum and the vaccination drive. Third, the global uncertainties and risks pose a challenge for the RBI-MPC to calibrate its monetary policy stance. On one hand, there are signs of improvement in the global economic outlook, as many countries have eased their lockdowns and ramped up their vaccination programs. On the other hand, there are concerns about the emergence of new variants of the virus, the uneven pace of recovery across regions, and the inflationary pressures in some advanced economies. These factors could have implications for India's external sector, financial markets, and growth prospects. Given these factors, the RBI-MPC may prefer to adopt a wait-and-watch approach and maintain an accommodative stance in its next meeting. This would help to support the ongoing economic recovery, while ensuring price stability and financial stability. However, the RBI-MPC will also remain vigilant and ready to act if there are any significant changes in the macroeconomic situation or the inflation outlook.